Among investors, there is a reflexive heuristic. When tanks roll or missiles fly in the Middle East, you buy gold and silver. It is treated as the ultimate, mathematically guaranteed safe haven trade. But historical data contradicts that instinct. When a major geopolitical shock actually hits, the immediate reaction is often a severe drawdown in precious metals. We saw this in the summer of 1990 during the Gulf War, again in the lead-up to the 2003 invasion of Iraq, and it is explicitly modeled in the baseline scenarios for 2026. In each case, the initial reality of conflict triggered a drop in prices. The relationship between an energy-centric conflict and precious metals is simply not a straight upward line. To understand why, we have to look at the dual causality framework. During a crisis, traditional demand for a safe haven fights against massive macroeconomic forces, and in the early days of a war, those macro forces often went out. Treating precious metals as an automatic early war hedge is a mathematical fallacy that exposes portfolios to catastrophic early losses. To see exactly why those losses happen, we have to look past the metals themselves and focus on fiat liquidity during a severe all-out conflict. In the acute phase of a market shock, cross-asset correlation goes to 1. Broad market portfolios crash simultaneously. As equities bleed, brokers issue institutional margin calls. Investors are suddenly required to produce cash immediately to cover their deteriorating positions. That cash has to come from somewhere. Institutions are forced into indiscriminate selling of their most liquid assets. They liquidate gold ETFs, not because they want to sell gold, but because they have to survive the week. In the first chaotic phase of a geopolitical shock, the ultimate safe haven is immediate US dollar liquidity. That said, the dual causality framework does have a left side, the structural forces that genuinely support gold during a crisis. This baseline support comes largely from sovereign entities and central banks reacting to geopolitical instability. We can measure the scale of this physical demand. In the first quarter of 2026 alone, central banks purchased 244 tons of physical gold. A primary driver for these purchases is sanctions hedging. Central banks stockpile physical gold within their own borders to insulate their national reserves from fiat currency freezes and geopolitical weaponization. Sovereign buying provides a high structural floor for prices, but a high floor does not make an asset immune to immediate macroeconomic cross-currents. Those cross-currents make up the right side of our framework, the macroeconomic transmission mechanism. In the Middle East, that mechanism begins at a physical choke point. Nearly 20 million barrels of oil flow through the Strait of Hormuz every day. Any disruption here triggers an immediate global energy shock. That supply shock directly translates to a massive spike in global oil prices. Expensive oil imports set in sticky inflation into Western economies. To combat this new wave of inflation, central banks are forced to hold interest rates higher for longer. That reaction yields 2 results: higher real yields and a stronger US dollar. Because gold yields no interest, higher real rates increase the opportunity cost of holding it. At the same time, a stronger dollar crushes the metal's fiat pricing. An energy-centric conflict actively weaponizes the macroeconomic environment against precious metals, turning an assumed hedge into a liability. We do not have to rely on economic theory to prove this transmission mechanism. We can measure it in historical market data. This chart shows the percentage change in the gold index during the initial phases of select military actions. Look at the January to March 2003 Iraq War period. As the reality of war set in, gold experienced a sharp negative 5% drop. We see the exact same pattern in the 2026 baseline data. A period of high pre-war premiums was followed by a severe sell-off of nearly 12% as rates rose and the dollar strengthened. The empirical data proved the rule. If a conflict remains contained or is purely oil-driven without immediate monetary easing, the initial market reaction is a precious metal sell-off. What about silver? It is a common assumption that silver moves in perfect tandem with gold during a geopolitical crisis. But silver has a structural vulnerability: its dual identity as both a monetary asset and a vital industrial commodity. When we look at the demand structure for silver in the United States, its exposure to the manufacturing sector becomes obvious. 25% goes to electronics, 15% to photovoltaics, and 19% to other industrial uses. The monetary demand is a minority share. That reliance ties silver directly to green energy and tech manufacturing, sectors that are highly sensitive to economic slowdowns. When an energy shock causes a recession, factories close. This creates stagflationary demand destruction, wiping out the industrial need for silver entirely. Silver is a heavily flawed geopolitical hedge. In a war that threatens global growth, it behaves like an industrial metal crashing, rather than a monetary metal rising. This chart models trajectories for a severe war scenario involving a Hormuz disruption. In Phase 1, 0 to 3 months, the trajectory dips sharply, driven by a liquidity squeeze. In Phase 2, from 3 to 12 months, it turns steeply upward after central banks are forced into monetary easing. If we plot silver on this same timeline, its initial drop is much deeper and more violent due to the sudden collapse of industrial expectations. Timing a geopolitical trade depends entirely on the timeline of central bank capitulation to a recession, not the timeline of military strikes. For institutional portfolio construction and macro hedging, this model dictates a very specific strategy. The optimal asset combination requires that any allocation to gold be paired with ample, unencumbered cash reserves. Holding cash is the only way to survive the Phase 1 liquidity squeeze without being forced to liquidate your gold positions at the absolute bottom. Utilizing leveraged silver as a geopolitical hedge carries excessive beta risk, exposing a portfolio to both early margin calls and broad economic contraction. To accurately forecast precious metals during a Middle Eastern conflict, analysts must stop looking at physical mining supply. The true leading indicators are US dollar liquidity, global oil capacity, and the physical flow through the Strait of Hormuz.